This is a countdown to the open. I'm Matt Miller in for Jonathan Farrell. We are moments away from the start of trading on Wall Street. Looking at futures that are reported down 0.75% on the S&P, down more than 1% on the NASDAQ. We've got some interesting bell ringers on this, the last trading day of the year at the New York Stock Exchange in Planet Fitness hats and what looks like a group of forest rangers over on the NASDAQ. There's the opening bell. Now, one stock to watch at the open today. First off, let me look at the euro dollar there. 106.75. Once again, every single day it's 106. You know, we don't need to include it if it doesn't change ever. The U.S. 10-year yield at 3.87. That's more interesting, actually rising a little bit to some relatively high levels there after starting the year at 150, and NYMEX crude at 78.42. Now, one stock to watch at the open, as I was saying, is Southwest. Again today, Transportation Secretary Pete Buttigieg ramping up the pressure following 13,000 canceled flights.
The U.S. Department of Transportation has your back. I'm disappointed that Southwest has not done more to proactively communicate with passengers. I'm assigning U.S. DOT resources to follow through on every complaint that comes in to make sure that you get compensated, and we will penalize Southwest as we would any airline.
I would have done that landscape instead of vertical. In any case, there's Pete Buttigieg, the Transportation Secretary. Southwest expecting a normal day of operations today, vowing to pay back thousands of customers over the coming days. The Chief Commercial Officer, Ryan Green, telling travelers, quote, if you had to make alternative arrangements like hotels, meals, rental cars, gas for rental cars, those will qualify for reimbursements. Bloomberg's Abigail Doolittle joins us now for more. Abigail?
Well, Matt, I am guessing folks at Southwest, including CEO Bob Jordan, they're probably wishing that this last week is a week that had not happened for them. I'm also thinking that some of them are wishing that they had invested in the technology that could have avoided all of the problems that they've had in terms of those more than 13,000 canceled flights. But now they are planning on paying back, probably some of this coming from pressure from the White House's Department of Transportation there, Pete Buttigieg, as we were just listening to, and maybe I would agree with you on that horizontal shot, but they are paying passengers for flight costs, meals, hotels, car rental. We all know what it's like in terms of T&E expenses at any workplace. Can you imagine what this will be like? But it sounds like it will happen. It could take weeks, though, again, for those more than 13,000 Southwest flights that were canceled, far more than other airlines, having much more to do with, again, the technology and other issues as opposed to just the weather. But today, if you're flying Southwest, good news is they're only planning on canceling 142 flights. So as this story has built, Matt, they've really responded because this is a tremendous bounce back from relative to just yesterday, 2,600 flights, and in the days ahead, far more. Not surprisingly, some of the union representatives are really saying that it's not just the weather and the the technology. It also has to do with management, but that is, of course, rhetoric. More to come, but at least things are getting back on track and folks are getting back home.
All right, yeah, absolutely. Hopefully people are getting back home and starting to fill out those forms in order to get their reimbursement. Abigail Doolittle talking us through LUV, that's the ticker LUV for Southwest. Now, big tech recording bigger declines. The NASDAQ logging its worst year since 2008, with some of the biggest names leading the way down. The FANG stocks and Microsoft, as well as Tesla, shedding trillions of dollars in market cap this year. Bloomberg's Ed Ludlow joining us now from London with more. So what a horrible year for big tech. And I guess the question that a lot of investors have, Ed, is do you get in now? Is it possible that they can't go any lower, or does this continue into 2023?
Well, you know, we hit a fresh low for the year on the 27th, which was just 2 sessions ago. We're down a full percentage point at the cash open on the NASDAQ 100. If we close lower this Friday, amid thin volumes, admittedly, it would be the 4th straight week of declines on the NASDAQ 100, its worst run of weekly declines since May, and what is the worst year for the NASDAQ 100 since 2008. I find it really interesting as well how all-encompassing this is. And you look at specific names, the semiconductor names like NVIDIA, mega cap tech stock, Apple, also having a pretty rough month of December. Interesting as well that this is the NASDAQ 100's worst year relative to the S&P 500 for 20 years. A big part of that story is energy, but I want to focus in on Apple because Apple in the month of December 2022, this last month of the year, is its worst month of performance going back 4 years to May of 2019. There's been a lot going on with production disruption in China, in Zhengzhou, where Foxconn assembles the Pro models for the iPhone 14. But now we're also pivoting to concerns about consumer demand. I talked about this being all-encompassing, right? The story of the year is the Fed and higher rates and how higher rates discount the present value of future profits. Then you think about yields and where yields have gone. They make those tech investments less attractive. On your screen, you see the shed in market cap of some of those mega caps. Among them, Tesla, one of the worst performers on the NASDAQ 100 year to date. But so you and I used to talk about how those names in particular would be a little bit more recession-proof, right, Matt? They would have strong balance sheets, entrenched market positions. Going into the first half of 2023, whether we get an earnings recession or a real economic recession, there's a lot of concern that actually there's a bit more pain to come when it comes to equities, particularly mega-cap tech.
All right, Ed Ludlow, the perfect person with whom to talk about the terrible tech returns of 2022. We'll be coming back to you in just a bit to get your outlook for 2023, as well as you host the Bloomberg Technology Program. Let's get right now back to our investor guest, Christina Hooper, Global Market Strategist at Invesco, and Will Smith, Head of U.S. High Yield at AB. Thanks very much for sticking with us through the breaking news and the market open. Christina, let me ask you about big tech. I mean, after such an awful year, Tesla, for example, down 70%. Have we hit a bottom?
Well, I don't think we've hit a bottom yet, right? We haven't seen the downward earnings revisions that we all expect. But the reality is that a lot of damage has already been done by the rise of rates this year. And that has put an enormous amount of downward pressure on tech names. So from my perspective, this is an attractive opportunity, dare I say a blue light special, for a lot of the tech names for investors with a long enough time horizon. That doesn't mean piling in right now, but it does mean, I would argue, starting to dollar cost average in over the next few months, probably the next 6 months. At some point during that period, we're likely to hit our lows for technology.
Will Smith, speaking of blue light specials, I mean, that's really your wheelhouse in U.S. high yield at AB. How does 2023 look for you in your sector?
We think returns for credit for 2023 could be very strong. In high yield particularly, we think all-in returns could be 10+%. Now, that's not going to be a straight line in our view. We think the first half, as we move from this environment of being concerned about inflation to an environment where we're concerned about growth and growth being weak, leading to higher defaults, we think that probably means that spreads widen at some point, particularly in the first half. But that's a very good buying opportunity for investors. If we think about what the all-in level of yields are now, they're very compelling versus history. For instance, you can buy a 3-month T-bill today at the same level of yield that you could buy a single B-rated high-yield corporate bond in 2021. So investors are getting paid a whole lot more today when we think about all-in returns and capital. And high yield at almost a 9% yield, the levered loan space at a 9% yield, investment grade bonds at 5+% type yields. Those are very compelling opportunities for investors. And I think to echo Christina's point, if you're a long-term investor, you're going to be pretty happy with those returns. But it's not going to be without volatility in the near term.
It's a good point. We're looking at a 2-year right now, 4.4%. That is not bad for risk-free over 2 years. Christina, if you're willing to go out a little bit further on the risk spectrum and not too far, as Will says, you're getting 5, 6%, 7% returns. Does fixed income look like a great place for an investor to be in 2023?
I do believe it does. I think we want to be selective. I think we want to emphasize investment-grade credit as we head into 2023, recognizing we're likely to see some hiccups early in the year. But I think this is a time to also be looking at munis, also be moving into high yield. This is a very, very attractive environment, in my opinion, for investors, especially if they have a long enough time horizon. But don't neglect equities. I mean, one of the biggest mistakes, if not the biggest mistake made in the global financial crisis, was investors abandoning equities, locking in losses, and not participating in a recovery. So I think it's critical to be well diversified, both across asset classes and within major asset classes.
By the way, Christina, we've heard a number of investors tell us this morning on Bloomberg Television, look at Europe, look outside the U.S. You know, don't recoil from the rest of the world after a crisis year. Definitely want to be diversified. What do you think about that?
I completely agree, Matt. This is a time to be looking outside the U.S. and ensuring adequate exposure, especially to areas like Europe, emerging markets, in particular China. While there are certainly risks to the scenario unfolding right now, I think there's an incredible amount of potential as the post-COVID reopening unfolds in China. There are a number of different markets where valuations are very attractive, especially China, and there's just an enormous amount of growth potential in China for 2023. So I definitely believe this is something investors should be thinking about and moving into. I notice also, Matt, my vision isn't what it used to be, but it looks like you're wearing a tie with bulls on it. Dare I say you're optimistic about 2023 as well?
They're zebras, but I understand. I also have an eyesight problem as I get older. Christina, thank you so much for joining us. Christina Hooper there from Invesco and Will Smith from AB. I wish you both a very happy new year. Hope you have a great weekend to start it off. Let's get to someone who probably isn't going to have the best 2023. FTX founder Sam Bankman-Fried. He met with senior White House officials at least 4 times this year before his crypto firm ultimately collapsed. Bankman-Fried's political ties coming under increasing scrutiny as he faces criminal charges. And we now find out that the Bahamas is holding what they say is $3.5 billion worth of FTX assets. Bloomberg's Kriti Gupta joins us with more on this developing story. Kriti?
Yeah, Matt, we'll start with that later point. $3.5 billion that they are now holding on until the Supreme Court of that country says they can actually return the money to some of the creditors and some of the customers of FTX. This is something that the CEO, John Ray III, had actually warned about, that some of the international customers may actually feel a little bit more pain when it comes to getting the funds returned than some of the U.S. customers. This $3.5 billion could actually help with that. But at the core of this story is, of course, SBF's meeting with the Biden aides. You mentioned it, at least 4 meetings with senior White House aides that include Steve Burchetti and Bruce Reed. Both are senior Biden aides. But of course, this is not the first time he has been in Washington. Him and his brother have both testified in front of Congress, met with SEC regulators, talked about philanthropy, and of course, some of the CFTC regulators as well. So this is just another kind of feather in his cap, as he's really kind of made the point that he is one of the ethical actors in the crypto space, really vouching for more regulation. Of course, he was also one of the largest political contributors to this election cycle, actually as following, by the way, George Soros, Michael Bloomberg, who of course is the owner and founder of Bloomberg LP as well. That makes Sam Bankman-Fried the 3rd largest political contributor this election cycle. So really tied quite closely with Washington, Matt.
All right, Kriti, thanks very much. We're going to obviously continue to get more out of this story throughout the next year. It's also going to be a tough year for Tesla.
If you look at some of the worst performers this year, it's your Amazon, it's your Teslas, it was the darlings of the last decade. And so what I see is this regime shift.
Or is it? When we come back, Wedbush's Dan Ives joins us to lay out what Elon Musk needs to do to get Tesla back on track. That conversation next. This is Bloomberg.
Peter Drucker has this quote, and I love it. He says, the heroes of the boom are the villains of the bust. And if you look at some of the worst performers this year, it's your Amazon, it's your Teslas, it was the darlings of the last decade. And so what I see is this regime shift. And that's where I get excited about the types. We're going to redefine what makes a good business model.
Tesla staging a little bit of a comeback in the final days of 2022, but Elon Musk was definitely a villain this year. The stock right now seeing its best day, or yesterday the best day in 5 months. It was a brutal year. The shares were down 65% year to date. Bloomberg's Ed Ludlow is back with us in London. And Ed Ludlow, the Peter Drucker quote I think is perfect for Elon, although you could use it for a number of other of the big tech companies because they did so well previously, they've done so bad this year.
Yeah, I mean, we were in the last trading session of the year, but reading the reporting on the Bloomberg terminal, a lot of the sell side notes, what investors are saying, there is now this kind of worry about the global economy, right? Particularly the price points of EVs, not just from Tesla, but other newcomers. We're up a percentage point on Tesla, rising for a third straight day. That's Tesla's longest run of gain since the end of October, believe it or not. But it doesn't change anything because the stock is still on track for its worst month on record, its worst quarter on record, its worst year on record. As you point out, Tesla is down 65% year to date. Interesting going into the new year where Tesla's expected to deliver record deliveries for a quarter. Around 420,000 is what analysts are looking for from Tesla for its global delivery numbers.
In the quarter.
In the quarter, right. And you know, there's been lots of reporting about how Tesla has scaled back production in Shanghai. You know, that Reuters report that between January 3rd and January 19th, there would be a pullback in production, generally speaking. And then from the 19th onwards, they would pause production altogether as part of annual maintenance. That all said, there are concerns about demand going into 2023. Morgan Stanley had that note this week with Adam Jonas, right? They see the inversion where 2023 supply overtakes demand. You look at the worst performers as well in the NASDAQ 100 this year. Tesla, of course, a big name from a weighting perspective when we started the year on the S&P 500 and NASDAQ 100, but Rivian and Lucid are the worst performers, full stop, on the NASDAQ 100 this year. And again, I see all these concerns about the macro environment and the price points at which these startups are selling their cars.
Rivian's the truck I want, though. That R1S looks tasty. Ed Ludlow, thanks very much. Coming to us from London. He'll be back in San Francisco soon hosting Bloomberg Tech. Right now I want to get over to Wedbush's Dan Ives, keeping his outperform rating on Tesla, writing, quote, "We remain long-term bullish on Tesla, although Musk must start to change direction here. Otherwise, this situation could get even uglier." I'm pleased to say Dan is with us here on set. Dan, thanks so much for coming into the studio and joining us. It's funny, when Ed said 400,000 and change for the quarter, I remember when that was their target for the year, right? So I don't think we should lose sight of the fact that this is a company that has a market cap still bigger than GM, Ford, and Toyota all put together.
Look, it's one of the most transformational, if not the most transformational companies of the last 20, 30 years. But look, they're held to a higher standard from a multiple perspective. They get treated, and I believe they should, as a disruptive technology, not an auto player. And that's why what you've seen here, I think 70% of it is actually non-fundamental. It's Musk, Twitter driven. And that's why any sort of course correction in 2023 is what investors are really craving for.
Yeah, you know, the Peter Drucker quote I thought was good. The heroes of the boom are the villains of the bust. I've always thought of it, though, in opposite terms, in that you want to pick the worst performers to look at, you know, some real upside for the future. Do you see it that way with Tesla?
Look, the hearts and lungs of Tesla is Musk. Musk is Tesla. Tesla, you know, is Elon Musk. And I think right now, you know, clearly they're going to have some softening like you're seeing across the board in EVs going 2023. But ultimately, he gets a CEO in of Twitter. He actually stops selling stock and actually does it, and it's not boy that cried wolf. And they set what I view as sort of cautious expectations. This is a stock that could rip higher. And I think that's ultimately it, is that Musk has gone from a superhero on Wall Street to a villain. And this is really a moment of truth for him to sort of navigate through the storm.
But he's been a villain before. Abigail was pointing out to me the other day that, or reminded me the other day that, remember, there was a time when he, I guess, pretended he was going to take over Tesla for $428. The SEC, he got in deep trouble with them and he kept egging them on. Nonetheless, he came back and people seem to forgive him for that. Is this time worse? I mean, has he really gone off the rails here?
Look, I think for someone that's viewed as a modern day Albert Einstein, Thomas Edison, it's more of a Howard Hughes type moment, right? And I think the question now is, does he start to focus back more on Tesla away from Twitter? Because that's really been it. It's a brand issue. It's been a black eye for Musk, a black eye for Tesla. But it goes back to investors. They want, this is a name they want to own as a transformational company. They just can't keep having Musk because every time he tweets something, the controversy, it's created ultimately a black cloud for Tesla. And that's why I think this is different because ultimately when you're at the perch, when you're at $1 trillion market cap, it's a lot different than being at 50 billion.
Yeah, his tweets are more, I think, Edison than Einstein. What stock, and because you're such a well-known tech bull, you cover the whole universe, which of these high flyers that has come down so much do you like best? I mean, when you look across, Apple, for example, came down to the lowest level that it's been since, I think, the summer of 2021.
Yeah, I mean, if there's one name, our top pick, it's Apple, because I believe it's not a demand story, it's really supply issues in China. On some of the parts, I still think there's a stock that could be a $200 stock, and ultimately, it's fundamentals continue to be rock solid, or what I believe, but I think right now, technicals and other, in tech, the New York City cab driver right now is bearish on tech going in 2023. Apple, in my opinion, is the best way to play. And then cloud, Microsoft, what I view as Redmond, that's still a rock of Gibraltar name despite what the stock's telling you.
By the way, how have you gotten through this year? I mean, it must have been tough for you watching all of these big names come down. You have outperform ratings on many of them. I know you took Tesla off your best ideas list, but it was still an outperform. How do you persevere in this kind of bear market?
Well, I think institutional investors that have known us since the late 90s, it's really in times like this that you handhold. As you're going through turbulence, we did it in 01, did it in 08, 09, we're doing it again this year. And I think it's trying to find the sort of the golden names that I view, and I think it's really walking through stress testing and handholding, because ultimately, when stocks are going up and to the right, everyone could be a hero. This is ultimately what separates fork in the road, and that's what we love doing, is navigating investors through this turbulence.
So stress testing, I'm sure you're doing it in your head, mentally stress testing all of the stocks you cover every day. What are some of the headwinds? What are some of the black swans that, or I guess gray, in that you're thinking about them that you worry about?
Ultimately, look, this is a Fed-driven Powell 10-year yield, as you talk about so often. That really ultimately, once the Fed takes the foot off the pedal, then you actually could see tech stocks and risk assets rip higher. I think going 2023 in January is, okay, clear the deck on numbers. That's, I think, what a lot of buy side are waiting for. Then you actually know these are hittable numbers. But I think the biggest black swan is Fed and, of course, China. That's the wild card in terms of zero COVID issues, supply chain. And I think ultimately that, in my opinion, is it under-owned, as I've seen tech going back to 2009, and I just view it, some of these names, it's more generational in terms of the opportunities given the risk rewards that we see.
By the way, I know you're a diehard Penn State fan, but you follow, obviously, college football across the spectrum. What are you expecting for the playoffs tomorrow? You got Michigan up against TCU and the Ohio State University playing Georgia.
Yeah, I think Michigan roll. It's a great TCU team, but I do think Michigan rolls with McCarthy and the team going through that game. And I believe, even though it's anti-consensus, I believe Ohio State and the Buckeyes win. And I think that's going to be a tough game, but I think Jan 9th, we will have a rematch of the game, Michigan-Ohio State, Jan 9th, SoFi Field. I think it's going to be great for Big Ten. I think Penn State also by a touchdown versus a tough Utah team in Pasadena.
All right. It gives me goosebumps to think about an Ohio State-Michigan rematch. It's exciting, but also terrifying for me as a fan from the great state of Ohio. Dan, thank you so much for coming in. It's been a pleasure having you here. And every time you come on this program, good friend of the show, Dan Ives from Wedbush. This was the countdown to the Open on the final trading day of 2022. I wish you all a very happy new year. John Farrell will be back to kick off 2023 on Tuesday. This is Bloomberg.
From New York City to our audience worldwide, welcome to the last day of trade of 2022. We are cross-platform. We're simulcasting radio, TV, one Caroline Hyde, one Paul Sweeney. We're having a blast.
We are?
Final day of trade, even though it has not been a blast along these markets.
No, today's trading, we're giving back some of the gains we had yesterday. So I got the S&P off about 0.8%. It just feels like, this is a day, I don't think people want to go into the weekend with any, exposure here. That's just kind of how it feels to a relatively soft tape with soft volume as well.
Yeah, we seem to be trying to tie things up, perhaps trying to stiff up a lip, as the British might put it, because boy, have the British had a tough year too. Let's talk about all of this with one Abigail Doolittle, who can really button up what has been an extraordinary year, whether you're in stocks, bonds, dare I even say a sprinkling of crypto.
Yeah, I mean, it's actually hard to know where to start because the sell-off has been so significant. The S&P 500 down about 20%, or a bear market, that NASDAQ 100 down even more, down 30%. But it extends right across the board. I mean, big tech, some of those indexes down more than 40%, the New York Stock FANG index, so all those mega cap names, the stocks. And then you also have bonds down because you're supposed to be able to put yourself into bonds when stocks are down as some kind of haven. Yeah, exactly. 60-40 this year, not really doing all that much. You know what's so interesting, though? Yesterday I was doing a little bit of a sort on the S&P 500. So naturally, we do tend to go toward where it's negative and where we have these big declines. But 175 stocks in the S&P 500 are higher, and we have a couple doubles on big names. Any guesses on the sector?
Energy.
Absolutely.
Yep.
Occidental.
Have I missed that trade? Have I missed that trade?
A double. I mean, a double in
Yep.
2022. There was another one. I forget which name it was exactly, but it was another big energy name. But we also have the defense contractors like Northrop Grumman and Lockheed Martin up about 40%. We have some of the staples like Kellogg and General Mills. So it's not all bad, but because we do have stocks down about 20%, bonds down about 15%, bonds the worst year since 1999. And it's not just treasuries, it's also credit. You have high yield bonds down about 16%, the worst going back to the history of HYG. And then LQD corporate credit down even more, down at 20%. So really nowhere to hide except for energy and some of those stock picking names, basically energy, utilities, and some consumer staples.
You think about technology. It's been such a leading group for equity markets and equity investors for a decade plus. I'm not sure that's going to be the case going forward unless rates really do come down meaningfully.
I would agree with you, Paul, and it's a big lesson because we're just learning the power. I mean, I think we've known about it the whole time, but I think that we now cannot take it for granted, Fed liquidity, because for more than 10 years, Fed liquidity, that helped out these stocks that never seemed to go down. And of course, they did have good fundamentals and amazing growth, a lot of them. But even as growth started to slow, I mean, growth was starting on Alphabet and some of these other names from massive growth to sort of more reasonable double digit a couple years ago, and they were still trading in a big way. But this year, you have Amazon down 50%, you have Meta down 60%, Tesla down 65%, NVIDIA, the chip maker, what about in 2020? We had the supply chain issues for the chips, and now we have NVIDIA down 50% on the year. So I would agree. As the liquidity comes out, folks are really having to look at these companies more closely, and especially the valuation.
Yep, good stuff. I mean, tech has been such a leader. It's going to be really interesting to see how they perform over the next couple of years. Abigail Doolittle covering all the market stuff for us here in our Bloomberg and Hour After Broker studio. All right, let's forget about 2022. That's my theme for the last few weeks. Let's look forward to 2023. Let's talk to some professionals who do this stuff for a living, see what we can look forward to. Joe Gilbert, Integrity Asset Management. He's a portfolio manager there. Joe, it says you're based in Moreland Hills. I'm just going to take a guess and say that's Cleveland.
Correct, Paul. And good morning. Thanks for having me on. Yeah, I'm on the east side of Cleveland.
All right, good stuff. Hey, Joe, I'd love to get your thoughts. What are you telling your clients right here? What's in your year ahead outlook letter to your clients?
Paul, so similar to you, we're just kind of throwing away the playbook for 2022 and looking forward to 2023. And so what we're telling clients is that it pays to be more constructive for 2023. I mean, I think as Abigail laid out, equity markets down 20% in the bear market territory, even some fixed income sectors and down 20% bear market territory. That will end this year. So we think looking forward, the setup for next year for 2023 will be a lot greater. And we just basically see inflation will come down. The Fed will stop raising rates. Earnings estimates will go down and earnings multiples will go up. And we think that will lead to a strong equity performance next year.
What's been interesting is the only places to hide, Joe, have been oil, energy, commodities actually having a really stellar year, but also the dollar. And I'm interested as to whether that dollar trade, whether that sort of headwind for earnings as well, if you're a global related company, is that going to dial back in any sorts as we see perhaps the Fed take its foot off the gas and maybe other central banks keep on pushing like the ECB?
I think that's a great point, Caroline. I think that as we look, the dollar has actually weakened since September. I think we kind of hit the peak in September. And so this last quarter, I think we're kind of getting a preview of how we think the market is going to play out next year. Investors are starting to position that the Fed is towards the end of its rate hiking cycle. I think this year really has been about the Fed, and you sprinkle in a little bit of a Ukraine war and China zero COVID policy. So I think that we get to a point that investors are looking forward that the Fed will no longer be such a headwind for the market. And then the dollar is kind of showing you that, and that's why you've seen a lot of weakness here in the last quarter. So,
I'm an equity guy, but I look at the fixed income returns this year. I mean, again, the Bloomberg Aggregate Total Return Index off 12.3% or something like that. And people in the fixed income biz will say that's a historic loss, historic performance, underperformance. So being the simple guy that I am, I just say I'm going to jump in both feet and buy some bonds here. What do you think about that strategy?
It's hard to disagree with that. I think that there's, similar as I said, the setup looks good for both fixed income and for equities for next year. As an equity guy, I'm a little more biased because I think that a lot of the bad news for equities has definitely been priced in as far as, and granted, there will be different sectors that outperform at different points in time next year, unlike fixed income. I think fixed income obviously will basically, as soon as the Fed, intimates that they're going to be done or they're pausing, I think you're going to have a huge rally in fixed income, but they're going to bring equities along with them.
As an equity guy then, can you go as broad brush as industry groups you like, or are you having to look as stock pickers kind of a market at the moment, given as we head into 2023?
I think that really that there are some winners and losers. The way we see it is, we've had the rolling corrections, and we think we're kind of going to see the rolling recession that will play through next year. And so I think within that, the way we're looking at it is kind of a first in, first out, Caroline. So it's more of the way we think about it is the companies and the sectors that have underperformed dramatically, the earlier cycle companies, those are where we're actually really looking for opportunities in. So that looks like more of consumer discretionary names, which are trading still pretty cheaply, pretty close to price to book. We're actually contrarianly and looking at home builders here because we think that it's a short cycle, it's early cycle, and so if we're right, and the Fed does start raising rates, and actually eventually we think they will probably cut toward the end of next year. Those are sectors that will do well, as well as industrials that have very limited inventory.
Hey, Joe, a viewer / listener just kind of messaged me and said, hey, how can stocks perform this year if we've still got some pretty significant earnings risk out there? How do you kind of factor that in?
Well, I think that the way we think about it is stocks went down 20% this year or more, depending on where you were. And they went down because, stocks discount the forward outlook. So they discounted earnings coming down. And so we think that a lot of that has been priced in. This year was really about repricing risk and repricing expectations. So I think that's where we really are. I think, and most of the time, stocks generally rally as, close to the last estimate cut. And so we don't know exactly when that will be, but we presume that it'll be early 2023, and that will basically be kind of the clearing event for equities to outperform.
Joe, talk to us about what you're going to be taking your cues from. Is it fundamental data? Are you going to be looking at the big broad brush data dumps that we get, the jobs market, whether it's inflation reads, that's what's going to be dictating you? Are you going to be looking more on the individual names, the earnings releases? What's going to be sort of your fuel, your catalyst to be getting in and out of the market?
Well, we're fundamental investors, so firstly, we're going to always look at what company managements are telling us, and so we use that as a guidepost this year as far as companies that have been less constructive, or most management teams are bullish about their prospects, but on the margin, they've gotten a little less constructive. So we're going to look towards that. But obviously, on a macro sense, we have to have inflation continue to come down. So those are the CPI and the PCE reports. Next week is actually going to be pretty big because we have a payroll number that we think will show average hourly earnings declining again, and probably less added to payroll. Unfortunately, what we think that really is going to be the key is that will probably make next year not as negative on an economic standpoint is that payrolls are probably not going to go negative just because there's a lot of job hoarding as far as company managements have been, once been twice shy. They don't want to release workers. They're going to probably just try to find a way to keep their payrolls not in a traditional recession where they will reduce them. They're going to probably try to keep them flat. And so I think that we're going to really have to take cues from the inflation data points that come in, the hourly earnings and service inflation.
All right, Joe, great stuff. Really appreciate you taking the time here on New Year's Eve. Joe Gilbert, Integrity Asset Management. He's a portfolio there. They're in Moreland Hills, Ohio. I just Google mapped it. It's kind of like in the eastern part, as Joe was saying, of Cleveland, right near the lake. So a pretty cool part of the country. Appreciate checking in with Joe Gilbert. Right now, let's get world and national news. Ritika Gupta. She is in London. Ritika.
I am indeed in London, Paul. Thanks for that. A House panel has released 6 years of Donald Trump's tax returns. That ends a years-long battle between Democrats and the former president, who fight to keep his financial records private. The Trump returns show that he and his businesses lost millions between 2015 and 2020. That let him minimize his tax bill. Vladimir Putin and Xi Jinping hailed deepening ties between Russia and China in a video conference today. Putin says the relations are the best in history. Meanwhile, Xi said China is ready to expand the relationship. Still, there are signs that Beijing is impatient over the political and economic impact of Russia's struggling invasion of Ukraine. After a week-long meltdown, Southwest Airlines is returning to a normal schedule today. Thousands of Southwest passengers were stranded across the U.S. because of cancellations caused by winter storms and overwhelmed technology. The carrier scrapped more than 13,000 flights in the last week. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Caroline.
Ritika, thank you. Let's have a check-in. Let's for a moment lick our wounds a little bit, because I was doing some of the numbers, and it is an extraordinary year. You pointed it out how bad it's been for bonds. Global bonds worst just since 1990 in some measures. Paul, global stocks worse since 2008. We've got some great boards for you. What interested me, Bitcoin has obviously had a terrible year, down 64%, but in fact, it's only its worst year since 2018.
Yeah, exactly. And, you think of all the things that's happened in the crypto space when a major exchange fails so spectacularly, and what likely many observers are saying includes fraud, you would think that the number one asset would reflect that. Bitcoin, it was trading at 20,000. Now it's trading at 16,000, but it's not zero.
Yeah, it has held on in, and I think many a crypto bull they'll take that for the amount of news that has hit them this year. I want to focus in on, let's be glass half full a little bit as well, because we're excited for the end. We're going to be celebrating this end of 2022, no matter what it served up for you cross-asset. But congratulations out there if you've been long commodities. The Bloomberg Commodity Index having a pretty stellar year, up 14% for 2022. Of course, it had a killer 2021. As we know, some of the news around why it did well was not a positive one for many people. But energy names, of course, really the outperformer. The dollar as well, King Dollar. I wonder if this is the end of it for 2022.
Yeah, I keep asking folks, smart folks to know this stuff. What's the bear case for the dollar? And, maybe rates coming down.
Yeah, keep a close eye on the Fed. We keep a close eye on Donald Trump next for you as well. This is Bloomberg. Welcome back. This is Bloomberg Markets Live. We are across radio and TV today on this last day of trading of 2022. Paul Sweeney, Caroline Hyde, and what an extraordinary year has been, not just if you've been a financial news follower, but just more broadly a geopolitical news follower. From the early days of February, I think of the amount that we're going to be digesting, the relationships, the reorganization of how the way the world converses, whether it's between Russia, China, whether it's between Russia, the rest of the world, whether it's between, well, certain players within the US itself, of course, as we did have we saw the midterms come out relatively, unscathed to a certain extent. We're expecting perhaps not much to get done in the year ahead in terms of US politics.
No, and there's still a lot going on in Washington even today. Talk about a data dump on a day before a major holiday. The taxes for former President Donald Trump have been released. We want to get the latest with Laura Davison. It just happened, just crossed the tape recently. Laura Davison from Bloomberg News joins us here. Laura, I know it's early moments of everybody sifting through the released tax reforms from former President Donald Trump. Any takeaways at this point?
Yeah, really. I mean, one, he has an incredibly complex financial picture, more than 1,000 pages worth of documents that were released about an hour ago. Detailing both his personal returns as well as his businesses. The businesses themselves were losing money for a lot of these years from 2015 to 2020. Part of those were actual losses, but some of those are all these tax breaks, depreciation deductions that are very favorable to real estate. So he was really able to minimize any tax bill that he might have to pay, including in one year in 2020 when he paid no personal income taxes.
And of course, we've heard him say time and time again that that's a smart thing to do, to use the tax codes as they stand to your advantage. What about the structure of the tax codes? What will next year bring, do you think, in any way?
Yeah, so this is the point that Democrats are really raising about this, saying, look, this shows that the tax code is broken. The fact that there are legal tax breaks for people who are very wealthy to be able to basically have a separate tax code from those that, normal wage earners might pay is a problem. Unfortunately for Democrats, they're about to lose their House majority going into next year. Democrats will retain control of the Senate. Republicans will control the House, which really just spells out gridlock for any sort of tax legislation. It's highly unlikely that the two parties will come together on any legislation that would result in raising taxes, particularly if this legislation were the result of some of the findings from Trump's tax returns.
So, Laura, these tax returns being released that'll provide some data on the former president's personal income, the income of his businesses. Will it give observers, analysts, any sense of his net worth and maybe the change of his net worth?
Not really. The problem with tax returns is they're really just a snapshot in time of earnings for a particular year. Because of Trump's net worth is so tied into real estate and other deals, that is all not really reflected on these tax returns in terms of valuations and things like that. That data just isn't there. So in terms of whether Trump is as rich as he says he is, whether he gained or lost a bunch of his net worth while he was in office, we can't say from these documents.
Laura, of course, you're busy coming on with us rather than having to pour through the thousands of pages. But just talk to us as a reporter, what you're going to be doing, where are you going to be looking, what do you hope to glean from all of this?
Yeah, so the real key question here is, so how much did Trump benefit from his own tax law? He, with the help of Republicans in Congress, passed a big tax cut in 2017. These documents give us a perfect example to look at, a couple years before that law change, after that law change. How were taxpayers like Trump able to benefit from these laws? What deductions were he able to claim, and which things was he not able to claim? One of the key things was this 20% pass-through deduction that was a key centerpiece of the bill, helped LLCs, partnerships, pass-throughs write off a bunch of their income. Trump actually wasn't able to claim that one because he actually lost money on his businesses those years. But going forward, if he were to make money, he would be able to take that deduction.
Laura, great to have some time with you. Thank you so much. We'll let you get back to the reams of documents, the data dump indeed, as we have the last day of trade here in New York. We thank Laura Davison over there in Washington for all things Trump taxes. Meanwhile, let's talk more broadly a little bit about geopolitics in and of itself, because we also had a key meeting happening overnight. Vladimir Putin, Chinese President Xi Jinping, sort of talking about deepening their ties. Remember from February when we first thought that this relationship was really cementing itself ahead of the Winter Olympics. And then, of course, Russia-Ukraine unfolded. Let's get up to speed with where this relationship is at the moment. Madison Mills is with us, she's here by phone. And what did we learn from this meeting? It seemed to be virtual, but there seemed to be a lot of, mutual respect shown.
Definitely, Caroline. There was a lot of commentary from Putin and Xi Jinping, both saying that relations are at their, quote, best in history. This was their first video conference this morning since the two met in person back in September, really underscoring Moscow's dependence on Beijing, Putin calling Xi a dear friend during part of the meeting. But we didn't necessarily hear that same level of commentary from Beijing. We have to remember here that China has refused to publicly condemn the invasion or even call it a war. Instead, their messaging has really been that, the U.S. has provoked Russia by pushing to expand NATO. So China not necessarily giving as much support to Russia, rather, as Putin might like. And again, just continuing to distance himself from Putin, Xi, that is, as this war continues to go on, which potentially Beijing didn't anticipate 10 months ago when this all began. I also just want to point out the scale that this war has gotten to as of yesterday. It was the largest bombardment in the history of this war so far. We have attacks, missile attacks, more than 120 of them. Power is out, 90% of it in Kyiv, attacks from Kyiv to Lviv, really showing Russia just not letting up on their strategy of literally trying to freeze out Ukrainians as we head into the winter months.
Madison, is there any sense or any expectation of China stepping up its support of Russia in any meaningful way, or was this meeting maybe a little bit more just for a show of solidarity?
I think we have to just listen to what we do know from Xi Jinping, which is that, they haven't said what Putin wants them to say, right? We haven't heard, a deep condemnation of Putin, which is what the U.S. would want. We also haven't heard deep support of Putin from Beijing, which is, of course, what Putin would want. So I think they're just trying to get their economy reopened, to get, COVID under control, and not necessarily freeze out Putin, a strong ally of China's in a time when they really need it.
I mean, a strong ally of China's in terms of also the oil flow that has happened. I mean, imports, exports have been crushed to Russia because of the geopolitical tensions, but they have managed to be increasing their exports of oil to countries such as China. Let's focus a little bit more on Russia and Ukraine right now, because that has been what in many ways has upended the commodity markets, the gas markets, what's really put so much strain on European economies in particular. Attacks at the moment, Russia versus Ukraine, where do we stand?
Yeah, so again, we had that largest bombardment in history yesterday, more than 120 missile attacks. But one thing I really want to zero in on, and we talked about this on the Sound On show last night, Russia's attacks are very, very specific here. They're not winning on the battlefield, so they're really focusing on the air in their attacks. But where we're seeing these attacks is really what's interesting to me. We're seeing them at museums, historic streets, cultural centers, areas where Ukrainian citizens go to, maintain and learn and celebrate their culture. I think that tells us a lot about Putin's motivations here. We know that Putin is hoping to kind of get Ukraine to recognize Russia's annexation of 4 areas in Ukraine, none of which, by the way, the Russians do completely control. And Russia is specifically targeting those historical sites in those annexed areas. So I think that just tells us a lot about where Putin's head is at in terms of motivation. I also want to point out where the Russian citizens are standing in this. A lot of the Russians who were, against the war have already kind of left the country. We saw that exodus happening earlier on. Again, we've been at this war for 10 months, over 300 days now. I'm, as we head into 2023, going to be really watching how Russians who are still there respond.
Madison Mills, thank you for keeping us up to date with all the ramifications of geopolitics on global economies as well. Let's have a quick look at where oil is trading at the moment. We're up 0.9% on the WTI crude contract. $79 is where we trade. The Brent crude contract also up more than a percentage point, $84. But actually oil has crept up only by about 5% all told on the year, Paul. It has been a very volatile year, most clearly in natural gas too.
It has been, but the energy stocks have just surged across the board, across upstream, downstream. Really strong year for energy equities.
That's for sure. From New York, stick with us. This is Bloomberg. Welcome back. Bloomberg Markets Live on TV and radio. Paul Sweeney, Caroline Hyde, and the last day of trading, pretty muted, lackluster. We're seeing, of course, volumes very thin, off by about 31% on the S&P, but the S&P itself is also off 0.7%. We're seeing the Nasdaq under pressure as well, Paul.
Yeah, kind of ending the year on a little bit of a whimper, which is probably pretty appropriate for how the trading has gone here this year. Let's get some details of what's happening on this last day of trading in 2022. We do that with Bloomberg Markets. Abigail Doolittle joins us here in our studio.
Well, it's really interesting because we've been talking all week about this Santa Claus rally, and right now it's literally unch for the last 5 trading days of 2022. It's going to be interesting to see what the first 2 days, of course, of 2023 bring. Now, typically when you have a Santa Claus rally that does happen, it means that the next year is going to be higher. When it doesn't happen, it's going to be lower. But of course, we had one last year, and that really didn't work out. So right now we have the S&P 500 down 0.7%, the Nasdaq down a little bit more, down 1%. This is yields are higher, volumes are low, and of course the big news on the year is the down year, the bear market for the S&P 500 essentially down 19.8% thereabouts. The Nasdaq 100 down even more, and yields climbing, so nowhere to hide. Bonds lower too.
How are people positioned? I mean, you're our volatility, our options expert as well. How have people been looking towards positioning themselves into the new year?
Well, it's really interesting, Caroline, in terms of the VIX, something that's been baffling to folks all year long is that it's so low. Right now, in fact, it's has a 21 handle. It's almost at 22. But the number one explanation for that is that institutional money, they're not as long as they would be, so they don't have to hedge. Now, is that true? It's hard to know, but it's an interesting explanation. The VIX hanging right onto the bottom of its range. If it should shoot back higher, probably toward 35 or so, which would suggest the new year could start with a sell-off. On the other hand, maybe that range breaks and maybe the bulls step in for stocks.
The S&P 500 Energy Sector Index up 58% this year. Wow.
It's incredible. It's incredible, especially given the fact that it was up 50% the year before. And you know what? Yeah. Okay. So we have the energy sector over 2 years, a double. I don't know that it's considered to be a sleepy sector, because it is actually technically a growth sector. But who knew that could happen? And I think that's a lot having to do with, mega cap tech really falling apart, down more than 40%. So folks wanting somewhere to go. What really stands out to me about the commodity complex in 2022, it's higher. The Bloomberg Commodity Index is higher. Oil is up about 15%. I believe natural gas is higher. On the other hand, wheat is up a little bit too. On the other hand, you have some of the metals lower, including copper. So a real divergent message there. And the reason that it stands out, because of course we have fears around a demand recession. We also have the Bloomberg Dollar Index higher. So it's not intuitive that you would have commodities higher. Those are risk assets. So you have this divergence between risk assets of stocks and commodities. What's 2023 going to bring?
Fascinating, the correlations. Also fascinating, of course, the push and the pulls of the global economy that does all this to whether or not we see commodities get a bid, particularly amid the China reopening. We thank Abigail Doolittle, and we dig in a little bit more into the commodity space. Now on Josh Young, Chief Investment Officer of Beeson Interests. Of course, you're focused on oil, on gas, on public equities in particular. Josh, just talk to us about, in particular, the China reopening story. It's sort of got everyone scratching their heads, and in the immediate focus, it feels that everyone's a little bit nervous. We're worried about the spread of COVID and how they're going to manage the short term. But in the longer term, does this mean that commodities could outperform once again?
Yeah, I think if you define longer term in terms of more than the next 2 or 3 months, it looks great. It looks like China is setting a target for a really high return in terms of flights, and we're starting to see congestion, essentially traffic on the streets in big cities, start to rebound in cities as they're on the tail end of their COVID wave. So yeah, I think it looks great from a short to medium term perspective. And as China turns back on, they also start to turn back on oil demand in other East and Southeast Asian countries. And so there could be a step up in terms of multiple millions of barrels a day of demand relative to where we've been over the last few months.
Josh, you're based in Houston, as I recall. You've got the energy stocks up almost 60% year to date. How good is life in Houston right now?
So it's interesting. Employment's actually not up that much in the oil and gas space. capital expenditures are not up that much in the oil and gas space. And the small cap stocks have lagged materially, unlike in past recoveries. So what it's setting up for is, even though those stocks are up a lot from their lows, it's setting up for a multi-year bull market where we could see maybe XLE and sort of the other like large and majors don't have as much upside here after their significant outperformance. But the small caps and oil services stocks, I mean, there's real potential there. And there's also a real potential for the revitalization of Texas and Houston. I mean, we're doing great, but it's not the same as it was in the sort of 2010 to 2014 timeframe where Houston was booming.
And a lot of that, of course, has to do with federal policy making, has to do with a pivot in terms of this economy, trying to focus in on climate change there as well. How much are we likely to see the smaller caps that you say in particular maybe start to turn on again? Maybe we start to see oil output increasing a little bit more in the United States, because that has been this interesting tension between the oil producers in the United States and indeed the US government.
Yeah, I think we need much higher oil prices to get oil production growth to be anywhere close to where people were expecting. So coming into this year, we expected oil production to grow by a few 100,000 barrels a day, and the consensus was, I think it was 1.2 million barrels a day. That consensus has come down a lot, and we've gotten production a lot closer to our expectation. And so what I think is actually going to drive the small cap re-rate is not going to be substantial production growth. It's going to be buyouts, where we're seeing large caps buy private companies at, let's say, 3 to 4 times EBITDA, and many of the small caps are trading as low as 2 times EBITDA. So there's real potential for a re-rate through acquisitions. And then also, just when you trade that cheap, you have the potential to pay off debt, buy back stock, pay a dividend, and sort of force a re-rate, which is not something you've seen from small cap oil and gas companies in the last decade.
Josh, how do you guys in the energy business think about the big picture of, I'm in the fossil fuel business, the world seems to be going green, it's probably going to take a lot longer than people thought. You know, how do you manage your business? When you talk to these companies, how do they think about the 5 to 10 year time frame?
So that's a great question. And one of the really interesting things is that institutional allocators are actually still divesting from the oil and gas space. So even though it's done really well over the last couple of years, I've noted Goldman and others have talked about this as well. There's still actually funds leaving the space from an institutional allocation perspective. So it's very hard to see capital formation, new companies and new projects funded, and oil production growth when you actually see divestment, and a lot of that divestment appears to be ideological, not economic. So what I think is going to happen is, over the next year or two, Goldman's estimate is the next year, we'll see maybe it takes 2 more years, money will start to flow back into the space from institutional allocators who, again, are still pulling capital. Private equity funds are still divesting. Insurance companies are still pulling their insurance coverage. When that flips and you start to see capital come back in, I think that's going to be the starting point for the recovery of production. And the really interesting thing is it takes many years to restore the oil services supply base, the ability to supply services, to then be able to go drill enough wells to get enough supply to get into an oversupplied situation. So I think we're set up very nicely for a multi-year oil bull market. And it really comes back to this divestment, like you're talking about, from the space, partly economically because the space did badly over the last 10 years, and partly ideologically, where it's real hard for investment committees at endowments and foundations and family offices to allocate, even though it's profitable and even though other sectors are doing poorly. There's just this big ideological obstacle to investing.
Some have, of course, sort of thought the turning towards natural gas as a supply of energy in the US is more friendly toward the environment. Natural gas has just been the most extraordinary commodity to follow this year for reasons we well know, and a lot of it to do with Europe and across the Atlantic. But to hit a high in excess of $9, to be back down to now $4.38, how do you see that part of your world looking for 2023?
Yeah, so I think natural gas is oversupplied actually right now in North America, and we will see sort of more normal temperatures. So it's been a relatively warm winter so far, other than this recent winter storm. And so weather's been uncooperating and supply has been higher than expectations. My view has been that natural gas would stay in this sort of $4 to $7 price range. And I think there might be a little bit of downside to that in 2023, but over time, supply and demand should balance out. And by 2023, 2025, there are a number of different LNG export facilities that should finish construction and come on. And at that point, I think we're set up for a meaningful move higher. But again, in 2023, it could be pretty rough on the natural gas side.
Josh, if I wanted to go down to Corpus Christi or Galveston and build a refinery, could I do that? Could I get regulatory approval? Could I raise capital? Is that even possible in this day and age?
Yeah, that's a good question. Honestly, I don't think that refineries are undersupplied. Okay. And I think that's been one of the big stories in 2022 where there have been a couple of points where the crack spread, so the refiner margin has been really high. And there's been this story about an insufficient supply of refining capacity. There may be an insufficient supply in a few years. The reality was that was mostly driven by China lockdowns, right, and millions of barrels a day of Chinese refining capacity, particularly the teapot, the smaller independent informal refiners going offline. And so as those are back online, there's actually plentiful refining capacity, and we see that with refining margins getting closer to normal levels. So yeah, it's really hard to build them, but frankly, we don't really need them.
Talking a lot about US supply-demand dynamics in oil and natural gas, just talk to us about OPEC Plus or what you're expecting for the next year in terms of the geopolitical risks around oil.
Yeah, I think OPEC Plus has been sort of a undertold story, partly because there have been a couple of different price wars in the last 10 years. It does appear that many of the OPEC Plus countries are hitting their peak production capacity and have actually had to produce materially less than their production quotas. And so there are a few countries that still have some excess production capacity versus their quotas, but overall it does appear that there is limited spare capacity. And so as China demand comes back on and as Russian barrels may be restricted from the market, we could be in a situation where there's a call on OPEC oil and where OPEC is actually not able to deliver. So this is a really sort of contentious call, but it should be less contentious, I think, because even senior executives from Aramco and various OPEC countries, they've talked about limited spare capacity. So, I think this is potentially a 2023 story, potentially a 2024 story, but I think there's going to be a point where the world wants more oil from OPEC and where OPEC is just not able to deliver.
All right, Josh, great stuff. You know what you're talking about. Josh Young, Bison Interest CIO, giving us the latest on the global energy space. I'm looking at WTI crude oil right here as we end the year, $78.80. Remember earlier, we were up at $120 a barrel, so big pullback in crude. Supply and demand, you have to have a call there when you're thinking about global energy right now. Let's go to Ritika Gupta. We'll get world and national news. Ritika.
Thanks, Paul. Former cryptocurrency mogul Sam Bankman-Fried held at least 4 meetings with senior White House officials this year. It was part of a push to influence crypto policy and build connections before his FTX empire collapsed. FTX's ties to Washington have come under scrutiny since the exchange's collapse. Bankman-Fried gave millions of dollars to Democrats. Some startling estimates of just how bad that COVID outbreak in China could be. According to London research firm Airfinity, there could be as many as 25,000 deaths a day. Daily infections could peak at around 3.7 million cases from the virus during Lunar New Year celebrations next month. It's been difficult to obtain accurate data since the COVID zero policy was lifted. And in Myanmar, Bloomberg's learned that deposed leader Aung San Suu Kyi has been sentenced to 7 more years in prison after being convicted of corruption. It was the final round of verdicts against her since the military ousted her democratically elected government in a 2021 coup. Suu Kyi's total prison term is now 33 years. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Caroline.
Ritika, thank you. Let's have a check-in now on what's happening across the rest of your markets. We've been delving into the world of the outperformance, the energy, the commodity space. It really has been your winner of choice on the year. Everywhere else, no let up really in terms of some of the pain trade. The S&P 500 trading down 0.7% on the day, and we see that add to about a 20% sell-off on the year. And really, in terms of Europe as well, Paul, we've seen Europe, relatively speaking, off about 12% on the year, but still yes, a pain trade.
Yeah, it's a pain trade, but they have less tech exposure, so that was kind of the story there for Europe.
Miners, more of the key and the oil companies, of course, for those sorts of benchmarks. From New York, this is Bloomberg. Welcome back. Bloomberg Markets Live. We are across radio and television today. Paul Sweeney, Caroline Hyde, digesting what has been a pretty seismic 2022, no matter which way you look at it. I think we've got to decide what our words of the year were. I think transitory, unfortunately, will have to be one of them. Supply chains. That was the word of 2021, and it certainly still seemed to be the one of 2022. The hopes that they were easing, and then maybe some concerns around China's reopening once again, Paul.
Yeah, exactly. I should have stayed awake, I think, more in my operations management, supply chain classes in business school, because that's the go-to story for the last couple of years, and hopefully things are getting better. Lisa Anderson, she's a manufacturing and SIOP expert and president of LMA Consulting. So, Lisa, we've all become, I guess, quasi-experts in global supply chains. Give us a sense of kind of where we are today.
Well, we have improved in terms of our ability to supply product to customers. However, we still are in a scenario where supply chains are on the move, continual disruptions continue to persist. It just keeps moving.
Okay, where's it moving to? Talk to us about the ramifications, for example, of COVID in China, and whether that longer term unplugs, but shorter term confuses for supply chains.
Oh, it definitely is going to impact supply chains because China is a manufacturing powerhouse. And with the zero COVID policies, they've been shutting manufacturing down. It certainly affected the iPhones as an example. But, the bubble continues to move. The supply chain is a system of systems. And so as it gets to the next point in the supply chain, it was at the ports, and then it went to rail, and now it's at the warehouses because we're completely full throughout the U.S. and are still looking for more space. Yet we don't necessarily have the products we need. To your point about the zero COVID policies and some of the products like the iPhone.
Hey, Lisa, when I was in business school, we did learn about a thing called just-in-time inventory, and presumably that's more profitable for manufacturers and the whole supply chain. Has that been called into question? Because now I'm hearing a new term, which is just-in-case inventory. Tell us how that may evolve.
Well, you're absolutely right. Just in time, everyone took quite literally for many years and just had inventory